Good morning, and thank you for joining the Bipartisan Policy Center for today's Fireside Chat with Acting Director Sandra L. Thompson of the Federal Housing Finance Agency. We are excited to be streaming to you live from our office in Washington, D.C. for what is one of our first in-person events at BPC since the start of the pandemic. It's great to move from exclusively virtual conversations to hybrid in-person events, and we are thrilled to have you, Director Thompson, with us this morning. My name is Dennis Shea. I'm the Executive Director of the J. Ronald Terwilliger Center for Housing Policy. Launched last December, the Terwilliger Center was founded to advance the goal of realizing a decent, safe, and affordable home for every American family. As a policy center within BPC, we are working to bridge the best ideas from both parties to develop a national housing strategy that works for all Americans. To that end, BPC has a proud record of working with and hosting past leaders of the FHFA, appointed by Republican and Democratic presidents alike, including former directors Jim Lockhart, Ed DeMarco, Mel Watt, and Mark Calabria. And it is truly a privilege and honor to add Acting Director Thompson to this list, and we know that today's conversation will be and is quite timely. Established in 2008, the FHFA has become one of the nation's most important regulatory agencies, but also perhaps one of the least known, particularly among the American people. It is the conservator of mortgage giants Fannie Mae and Freddie Mac, and the chief regulator of the Federal Home Loan Bank system. Between these two roles, Director Thompson oversees more than $7.2 trillion worth of funding for U.S. financial institutions and mortgage markets, and that's trillion with a T, in case you missed it. A Chicago native, I've learned this morning, a proud White Sox fan, and a graduate of Howard University. Acting Director Thompson has contributed more than 4 decades of her life to public service. Thank you. For 23 years, she worked in various roles at the Federal Deposit Insurance Corporation, including as the head of the agency's Risk Management Enforcement Program during the 2008 financial crisis, and later as the agency's Director of the Division of Risk Management Supervision. In 2013, she moved to the FHFA and served as the Director of the Division of Housing Mission and Goals and Acting Director before being nominated by President Biden to lead the agency on a permanent basis. In just a minute, we'll get the conversation started, but before we do, I want to offer a quick reminder to our virtual audience that they can submit questions for Director Thompson by tweeting them to @BPC_bipartisan. Let me repeat that, @BPC_bipartisan. And you can do that throughout the webinar by using the hashtag BPCLive. You're also welcome to submit your questions in the YouTube chat. If any of our in-person attendees has a question, and I know some of you here, it's not a bashful audience, kindly raise your hand throughout the show, and a BPC staff member will follow up. With that, I want to offer a very warm welcome to you, Acting Director Thompson, and thank you so much for joining us today.
Thank you.
I want to start by asking you something that is foundational to FHFA's mission, and that's the idea of promoting safe and affordable access to mortgage credit. During your confirmation hearing, you stated, and I'm quoting you, that safety and soundness and access to credit are not mutually exclusive. Now, some might say that these two objectives, while not mutually exclusive, are definitely in tension. So I'm trying to probe your philosophy here. At the 30,000-foot level, how do you approach this fundamental issue?
Sure. So first, thank you for having me here. I think it's a real honor and privilege for me to sit here and have this conversation with you today. But you mentioned, as my background at FDIC, I have served in 2 crises, and I don't want another one. Having said that, there are some lessons learned. And one of the lessons learned, especially from the most recent crisis, the Great Recession, is that safety and soundness and access to credit are 2 sides of the same coin. They are not mutually exclusive. You can't have, it's not either or, it's and both. And I say that because we learned a lot of lessons through the last crisis. We learned what irresponsible lending was. People thought that they were promoting access to credit, but the lesson that we learned was ability to repay. Does a borrower have the ability and willingness to repay? And many times when I speak about access to credit, I think about not just affordability, but sustainability. There's absolutely no point in giving someone a loan that they don't understand and a loan that they can't afford. You'll recall in the Great Recession, there were loan products, the 227s, or the 327s, the 228s, where people were able to get into homes, but they weren't able to stay in the home. And so making sure that borrowers understand what they're getting into and that they do have the willingness and ability to repay these 30-year, most of the time, mortgages is really important. So we try to focus on sustainability and affordability. And I do think that when you're talking about sustainability, that is a safe and sound threshold. I mean, the loan has to be safe and sound before we would offer it to or allow Fannie and Freddie to buy from a borrower.
Let's talk about the access to credit.
Sure.
I mean, as I was preparing for this interview, I read your report to Congress and reminded myself of the various duty to serve requirements, the affordable housing goals, the contributions to the Housing Trust Fund and the Capital Magnet Fund at Treasury.
Right.
I don't think many Americans know much about that. Could you just educate us a little bit, educate everybody?
The charters for both Fannie and Freddie and the home loan banks have a different requirement, but it does require the enterprises to provide broad access. And that's broad means everyone. And what Fannie and Freddie have generally focused on are, the loans that are easiest to do. I mean, anybody can make a loan that has a 780 credit score or a 70 LTV, but there are areas across this country where it's not so easy to get financing. It's not so easy to get a loan. There are underserved areas, whether they're in rural America, whether they are affordable housing or manufactured housing, or underserved communities, communities of color. And so we've asked Fannie and Freddie not just to focus on the things that are easy to do, but also to provide liquidity in areas that are underserved. And certainly in underserved areas, many times you will have high costs for financing products. And so making sure that the people that actually need access to credit can get it, but in a safe and sound manner.
Well, you've been busy. I've noticed that you've made some significant changes. You've eliminated the adverse market refinance fee, imposed higher loan limits for areas across the country, and hikes in upfront fees in most high balance mortgages, and those for second homes. What have these steps accomplished, and what are your priorities for the coming year?
Sure, so it's a great question. So with the adverse market fee, I would just remind everyone
remind people what that is.
Well, the adverse market fee was when the pandemic first started, certainly there were lots of unknowns and lots of uncertainties associated with what was going to happen with the mortgage market, how was it going to be impacted, what were the losses that the enterprises were going to have to undertake. There was the CARES Act, which was 12 months forbearance. Servicers didn't know how long they were going to have to advance, and no one knew exactly whether borrowers could or would be able to pay. And so an adverse market fee was placed on certain loans, on refis in particular, to deal with some of the unknown expenses that were going to be associated with this pandemic that nobody had ever dealt with before. And so it was my pleasure, actually, to be able to say that looking at some of the borrowers that were in forbearance, in the enterprises book, many of them continued to pay. And the book really performed in a way that was unexpected. And so the losses that were anticipated at the outset, and again, they were unknown, they never came to fruition. So we were able to look at the actual experience for the enterprises book. We were able to actually remove that market fee. And it was interesting because there are lots of stakeholders in the mortgage process, and some people liked it and some people didn't. The enterprises were one of the ones that didn't, because they were able to start building capital and keep the fees. But I would say this, we heard, well, sellers aren't going to pass through that savings to borrowers. And I said, I think they will, and I believe that they did. And it was very helpful because many people were able to take advantage of the refi market at record low interest rates. And so we were very pleased about the policy that would allow and be beneficial to sellers and to borrowers and the enterprises alike.
But the book of business of the GSEs performed better than much better than expected, right?
It did, and it was interesting because when you look at, just the unknowns associated, people weren't going to work. In fact, I think we were out for the day, I think it was March 13th on 2020. I'll never forget it. We were going to do an agency-wide, like off-site test to see if our systems could handle it, and we never went back to work. I mean, we still haven't, but there were just so many uncertainties. People weren't going to work. People were concerned about the mortgage pipeline, and I would say that the Fannie and Freddie and FHFA did a really good job making sure that the mortgage pipeline kept moving, especially when you think about what's involved in a home purchase or even a refinance. The appraisal process. Appraisers didn't want to go into people's homes, and people didn't want to let them in there, but we figured out a way to keep the pipeline moving. And I would say that in 2020 and 2021, those were record years of loan acquisitions, refis, for both Fannie and Freddie. And so I think that was really a great way. People worked overnight and all through the week and weekends to try to figure out ways to make seamless transition so that the pipelines could keep moving and the processes, could continue to work.
Very interesting. So what are your priorities going forward? Give us a little glimpse into what you spend a lot of your day doing and focused on.
Yeah, so, there are a number of stakeholders that play a huge role in the mortgage market. And one of the things that we're doing is trying to position, like Fannie and Freddie are now able to retain capital. We're looking at some of the returns that they're getting on their mortgages, mortgage acquisitions. We're looking at pricing. I think I mentioned last year that the agency hadn't done a holistic review of pricing since I think 2015. And we really need to balance a number of objectives. One, we need to have some viable returns, and we also need to meet the core mission, and we need to think about how we do that in a safe and sound manner, because as you said at the outset, sometimes there is healthy tension. When you think about core mission products and core mission activities, the statute allows the enterprises to get a lower return than that which they otherwise would need. And so making sure that if there's a subsidy that's going the right place, that we're pricing some of the products and programs in an appropriate way is really important. So we've asked the enterprises to work on this. It's in our public scorecard this year. And we think that that is going to be a huge undertaking because it's going to be so impactful. All of the products, all the programs that the enterprises focus on are going to be under a review for pricing.
Okay. Well, thank you for that. One of the big concerns, or our primary concern at the Terwilliger Center, is focusing on housing affordability. How do we promote housing affordability? And a big problem, the major causes we see it behind the affordability crisis, is the lack of supply of homes, both for rent or for sale. There's been one estimate by the National Association of Realtors that we've underbuilt housing by about 6 million homes over the past 20 years. So this is our focus. So I mean, I know the role that FHFA and the GSEs, the enterprises, perform in providing, obviously, a critical role, vital role in providing liquidity to the mortgage market. But can they play a role in supporting more, or do they play a role in supporting more affordable housing supply?
Well, great question. Certainly, as you said, the enterprises they're secondary market participants, and we've really been thinking about ways that the enterprises can contribute to the supply issue. And when you talk about the lack of supply, you're also talking about, historic increases in home prices. Like last year, we saw an 18.5% home price increase year over year.
Good if you own, not if you don't.
Yeah, good if you're on and you're moving someplace to rent. But it is really, especially at the entry level for first-time home buyers, affordability is a huge issue. And I've said this a number of times. I know that no matter where you are, if you have a home, especially last year, if you put it on the market at 9, you'd have 6 certainly bids by noon,
Right.
and some of those were cash buyers. And so we think that there are things that the enterprises can do. On the single-family side, they have been looking at these accessory dwelling units, and Fannie and Freddie both have pilot programs that are in place now to purchase some of these units. Of course, the issues that we run into are
Actually
primarily
purchase the units.
yeah, actually purchase the units, and 2, to actually use the cash flow from the units in the underwriting criteria, because it's a cash flow that's coming in. And so we're trying to figure out ways we can be helpful, because these ADU units are there. The issue that we've run into is mostly at the local zoning and ordinance levels, which we certainly don't have anything to do with. We also have been looking at manufactured housing programs, and the enterprises have programs in place that allow them to purchase manufactured housing. And so I'm not sure that we have done a really good job.
Purchase the manufactured homes,
Yeah.
not the loans that are financed.
Well, the loans,
right.
and both. I mean, there's communities on the multifamily side, but there's also actual home and loans for those homes. And those manufactured homes are easier to build, they're quicker to build. And I think we need to do a better job with the narrative, because sometimes when people think about manufactured housing, they're thinking about maybe a single wide or double wide trailer, and there's nothing wrong with that. But the products that we are seeing today are, just equivalent to stick built, and it's really just a whole new dynamic. And so we're looking at ways there. We also have been looking at the enterprises' REO portfolios, and between the 2 of them, I don't think they have 10,000 loans or properties in their respective portfolios. So the supply shortage is real, and we're trying to figure out ways we can address that. On the multifamily side, I think we have increased the enterprise's ability to do LIHTC investments. They each had $500 million that they were allowed to invest, and we increased that up to $850 million. And so we know that on the multifamily side, especially at the affordable level, that they're really doing a good job in trying to help in areas across the country. And I would say out of the 850, half of that has to be affordable. Half of it has to go to our duty to serve program. And so we're looking at that. But I would say, I've been thinking about this. I don't know that people are going to be going back to work to the extent that they have been previously. And so we've asked, about, office space. Is it convertible to like mixed use properties? And what are the dynamics? What are the costs involved in that? So we've asked Fannie and Freddie to take a look at that. I met with the National Association of Home Builders on Tuesday of this week, and we're just sitting there trying to think about, what can we do to be helpful to address this national supply issue, because it's real and it really needs, all of our focus. And as you know, there are some things that we can't do anything about, like the labor shortage and then some of the supply chain issues. But, to the extent that there are, suggestions that people have, we certainly are open to them.
Yeah, I mean, I think you're right. I think the pandemic has changed the value of the home. I think one of the enduring legacies will be that it's a place of work. It's become a workplace for millions of Americans. So this idea of converting unused commercial space into residential property, it's something we're looking at and very closely to see what solutions are occurring at the local level. But over a year ago, the Biden administration published an executive order which specifically identified minority communities and poor rural communities as places that the federal government has historically disadvantaged through our laws and public policy choices. And you kind of touched on this, but could you walk us through the steps you have taken to encourage the GSEs, the enterprises, Fannie and Freddie, to more effectively serve these communities and the people who live there?
Sure. So one of the things that we did was we're requiring the enterprises to submit to us equitable housing plans. And they are supposed to focus on, one, identifying some of the barriers that have existed over time, and then coming up with solutions to address those barriers. And we really believe that the underserved communities, and again, I go back to your very first question, second question. So duty to serve focuses on underserved communities. It focuses on rural communities. It focuses on manufactured housing communities. And it also focuses on affordable housing preservation. But we hadn't.
Which is very important.
It's extremely important. And I should mention the enterprises also have good reno programs as well that we're working on, because we're finding that a lot of people want to stay in place. And so it's easier to stay in place and renovate than it is, or maybe to buy, sell your home at a high price and have to buy another high-priced home. But with regard to the equitable housing plans, it's really important, and the enterprises have really embraced, just trying to focus on identifying barriers that had existed previously in some of these underserved communities, and then trying to come up with activities and objectives to try to address those barriers. So they will likely be doing a lot of pilot programs with a number of sellers to see what works and to see what doesn't. And that was another thing that we think is important. We want to be transparent about these pilot programs because we want to make sure that people know what we're doing, they know what the objectives are, they know, what the criteria for these programs are, and we want to be very clear. We don't want to just have 10 pilots going on and people trying to figure it out. So we're really working with our comms team and the comms team of the enterprises to figure out a transparent way to communicate exactly what we're doing in these equitable housing plans. And so we do think that those are going to be really good activities and objectives. And we're really looking forward to kind of releasing those plans in the near term. The other thing, we are participant in the appraisal task force that was led by Secretary Fudge and Ambassador Rice. And certainly we have, millions of loans of appraisal data, and lots of research is being done at both Fannie and Freddie. And Freddie's research on undervaluation in minority neighborhoods has been very helpful as it relates to just kind of informing, not through anecdotes, but through data, what some of the valuation issues are. When we were looking at valuations previously, we tend to look at overvaluations versus undervaluations. And this was the first time that we'd ever addressed that. And so we think that the data that we provided was helpful.
Why would you look at overvalue? Because more exposure, more
more
risk.
exposure for the enterprises.
Exactly.
Nobody ever thought to look at
the undervaluation.
The undervaluation. And even in the Great Recession, when we looked at some of the repurchases that the enterprises were making, they actually had a number of repurchases that were due to valuation issues. And so, again, wanted to make sure from an exposure, risk exposure perspective that we were getting it right. And so Freddie they looked at the over and they also looked at the under, and we were quite surprised because we do have loan level data. And just think that some of the issues.
Is it a question of education, or what is the?
There are lots of questions of. One is, the appraisal industry itself is not as diverse as it could be. And I think there's a commitment amongst all sellers and certainly the federal government and others to take a look at the appraisal industry. There are lots of jobs in the mortgage industry that people don't know about.
Right.
And really trying to bring some diversity to the industry, I think, is going to be really something that we focus on. But the appraisal industry in particular is going to be very helpful.
Thank you. I mean, regulators as well as nonprofit and for-profit stakeholders have identified special purpose credit programs as tools to help close the racial homeownership gap, which is between white and black is 30 percentage points. It's pretty outstanding. And the BPC has a housing council that is focused on racial equity and housing. And they, believe they wrote to you earlier this year, wrote to actually Secretary Fudge, trying to get clarity on whether special purpose credit programs are consistent with the fair housing laws. And I was just wondering, what is your view on the potential of these programs to improve access to credit?
So we think these programs have great potential, and we wanted to make sure that lenders and sellers had clarity on any concerns that they had from a fair housing perspective with that program. So I think Secretary Fudge issued a letter or wrote an opinion that was very helpful. Right. And the OCC, certainly who are the regulators for the larger lenders, issued a letter of support, and so did we. And we think that the special purpose credit programs will be very helpful and beneficial in the equity housing plans that we've asked the enterprises to submit. So they'll play a role there. And we actually also had a request from one of the home loan banks to utilize a special purpose credit program in their district for the purposes of affordable housing. And you do know the federal home loan banks have affordable housing programs that are quite useful as well.
Well, great. Yeah. Well, I would be remiss if I did not ask you this question. It's been 14 years. Yeah. 14 years since the Fannie and Freddie were placed under conservatorship, under your tutelage. Yeah. And Mel Watt, then the director of FHFA, came to speak at the BPC 6 years ago. And he pointed out the growing risks of political inaction on the GSE's conservatorship. But at that time, the GSE's capital reserves were shrinking, credit and non-credit related factors were impacting profitability. It was a different time, I guess. But how do you approach the issue of housing finance reform, and what will happen if it continues to stay largely absent from the political conversation?
All right, so two things. One, I don't think anybody ever expected the enterprises to be in conservatorship as teenagers, 14 years. I know when I started, I think they were in the third grade, but they've moved on to high school. But I don't think that was the expectation that anybody had at the time they were placed into conservatorship and going forward. And as you know, under Mel, under Director Watt, they were able to retain only $3 billion in earnings after having repaid, whatever was given to them by the Treasury and the government. And under Dr. Calabria, they were allowed to retain earnings, which they are doing today, and build capital. And so, there's a huge gap there. But with regard to my views, I think there are a number of things that need to take place. One, there's the big ticket items, the things that are obvious to everybody. Certainly, conversations with Treasury as a significant shareholder have to take place.
Oh, definitely.
And I know that lots of people have views on that, but those conversations are, not as easy as they could be. The nice thing is, we've had precedential conversations given what happened in the Great Recession. So the issues, while they're specific to Fannie and Freddie, are not necessarily new to the federal government at large. But there's also the devil in the details conversation. Yeah. One of the things, that we are doing is we're preparing the enterprises to adjust to supervision in a way that they would be regulated outside of conservatorship. I think that the safety and soundness of the enterprises, making sure their operations are really in tip-top condition, which they are, making sure their financial condition is as expected and that they never have to rely on the federal government, again, I think is really important. So there are a number of things that we're putting in place. The pricing is really important. I think if the enterprises ever get out of conservatorship, everybody knows it's going to be the largest IPO ever, but there are going to be questions that investors will want to know. One, what is going to be the role of the government? Are they going to continue to have a PSPA? Are they going to be working under some sort of consent order? Are they going to be a utility? Do you have rate setting authority? Is it going to be, they're just questions that investors will want answers to before they put a dollar in. And those are some of those questions I cannot answer.
Just give us a little primer.
Sure.
So there are private shareholders of Fannie and Freddie, common stock.
Common stock.
Treasury has given $191 billion or so to the GSEs, and in exchange for that has gotten senior preferred shares. But the government has returned about $300 billion has been returned in the form of dividends to the Treasury Department. Is that all correct?
That is correct.
Okay.
On average, yeah.
Okay, so level set.
And then there's junior preferreds. There's like different classes of capital stack, but
so unwinding
that is not it's not a small undertaking.
Right.
It really isn't. So the enterprises, are they going to be subject to the single counterparty requirements of the Fed, where some of the largest SIFIs can only hold, 15 or 25%? So what is how much MBS securities do they hold? And are we going to have to make changes for that? What's going to be the rules under QRM? There's just a lot of different, they might be little things, but anytime you involve like two government agencies, right. I was going to say multiple, but I left it at two. Having those conversations can be quite challenging.
Wow. Well, I think we have some questions from at least the virtual audience. Could we get the first one?
Sure. This question comes from social media. For nearly 90 years, the Federal Home Loan Bank System has played an important role in supporting community banking, economic development, and affordable housing. But advances to member banks and the system's assets have declined precipitously in recent years. Do you believe the Federal Home Loan Bank System is still relevant, and would you support the creation of an advisory committee or commission to explore the future of the system?
So great question. Certainly the Federal Home Loan Bank has provided liquidity for a number of years. The advances are down now, but they were pretty high during the pandemic. And this happens after every single crisis. The advances go up, then they come, when people need them, they're there, and they perform very well. And then when the advances come down, then these questions always come up. This is after every crisis. Are we thinking about, and would we be open to an advisory committee? It is something that I have been thinking about. I just have not. I've had to deal with other things, but for us, transparency is pretty important. It's very important, and public input and stakeholder input is extremely important, because every decision we make impacts lots of different stakeholders, and where you sit is where you stand. And before we make policy decisions, I really like to understand, here's the issue, who's involved, how's it going to be impacted, and then we can make a more fulsome decision. And that's one of the nice things about working with so many unshy stakeholders that are not they're not afraid to tell you their views on anything. But I think an advisory committee, that's a good idea. Maybe something we might give some consideration to as we move forward. But we do try, to the extent we can, when we have a major policy decision, to try to get as much input as we can, whether it's through regulation, through public comments, or even RFI. We just had a listening session 2 weeks ago on the alternative credit score models. Yeah. Because the enterprises and everybody's been using classic FICO, for 20 years now. And so the question that we posed is, we've been working on this process for a number of years now. Legislation was enacted that asked us to put in place a viable process to evaluate alternative credit score models. And we've been working on it, and we will make a decision for the enterprises. That decision is going to impact lots of sellers, lots of stakeholders, mortgage insurance companies, anybody that has an LTV credit score grid.
Ripple effect.
It's going to have a huge ripple effect. So we did a listening session a couple of weeks ago to try to get input because it's going to be impactful. And when people think about credit scores, for example, they think about access and just the eligibility for the access to credit. But it's pricing, it's investor disclosures, again, it's MI, it's in our capital rule. I mean, it just is pervasive. And so to make a change like that is going to have huge implications. And it's not something that it's not an issue that we want to make a decision on in a vacuum. There's operational changes. People are going to have to change models and systems. And it's just very impactful. And so when we have to make decisions like this, it's really important for us to understand who's going to be impacted and to what extent. And something like a credit score update, whether it's to a single score or multi-score, and we haven't made that decision yet, is going to require an implementation period with a long runway because of all the work that has to be done.
With the opportunity to review it along the way.
Yeah.
Thank you. I think we have a question, at least one from the audience.
Madam Director, thank you for your service. 4 decades is nothing. I started HUD in 1974. I think I'm in my 5th decade, still going strong. I really don't have a question, but I have a prediction, and the prediction is this. I believe Fannie and Freddie will be a cicada event, getting them out of conservatorship, and that's 17 years, and you will be the director to do it. You're laying the foundation, and I believe you will be confirmed, and you will see them get out of conservatorship, which will be music to my ears because I've worked on the legislation that basically created the regulator, et cetera. So I want to leave this earth or leave my professional career seeing that they are comfortably in place of what they're to do. So best wishes for you. You're doing a great job and wish you well. Thank you.
Do you want to respond to the cicada event?
No, I don't. I do not. I do not.
Okay. Do we have any other questions here in the audience? Now, don't be bashful, please.
Hi, Sandra. Great to see you again.
Could you please identify?
Oh, sure.
Trent
Reasons with EY Parthenon, and had the pleasure of working together at Treasury. That was a wonderful time. I was thinking about as you were describing these different challenges of affordability, pricing, different data and metrics, and also this issue of access and equity.
Yeah.
In our own research, we've found that there could be upwards of 40 to 60 basis points of difference in discriminatory pricing, controlled for cohorts for income and things like that amongst different racial groups and minorities. I'm wondering, when I think about government's use of technology and data, how do you think about that as the leader of FHFA and along those different dimensions of whether it's as a regulator, as a policy setter, as thinking about the exit of conservatorship and so on? How do you think about technology and how it should be deployed appropriately within your sphere?
So great question. I think technology is really important. I think it needs to be deployed effectively, and it can be used as a good risk management tool. And I'll give you an example. At both enterprises, as part of the underwriting process, people input their incomes and assets, and we right now, you can validate that from a risk. You can use technology to validate, certain data fields that really provide the enterprises with more information from a third party that isn't necessarily vested in the process. They're just vested in the accuracy. So from a risk management perspective, we think technology is important. And I've been on record, I do believe that technology in the mortgage industry we really need to be thinking about how we can use it to make the process more efficient, faster, and cheaper for the borrowers. And again, when I think about the way we live our lives today, it's different from the way that we have lived 20 years ago. When you think about even the pandemic and, the gig
The gig
economy,
yeah.
people are self-employed. I don't even think they had TikTok 10 years ago or 20 years ago, but there are influencers, and I'm just using this as an example, but the way that we think about, employment and income, we need to think about, we need to incorporate some of that into the underwriting. That's not in lieu of, that's in addition to. And I say that because this is one big thing that I didn't mention that I wanted to, and this has to do with the access and the safety and soundness. So Fannie Mae had announced that they were going to incorporate rental payments into their underwriting decisioning process. And many people thought, oh my God, the world's going like the hell in the handbasket. But the fact of the matter is, because the rental payments are an expense and not a debt, they weren't considered as part of the underwriting decisioning process. And to the extent that a home payment is pretty much the largest payment that most people make, it seems to me that that would demonstrate not only the ability to pay, but the willingness to pay. And that ought to be considered in terms of the normal 5 C's, the creditworthiness and the character of the individuals. And so just thinking about ways to incorporate technology to try to make the process faster. I mean, I mentioned I had like 3 rate locks when I was trying to refi my loan, and it just takes so long. But it is a huge asset. It's the largest asset that many people will purchase over their lifetimes, and risk management is really appropriate. But there have to be some ways that we haven't thought about where we can utilize technology to manage the risk, but make the process a little more efficient.
Great. We are fast running out of time. We have one more question from the audience. I think this gentleman in the back had the question. And then I want to ask you a question, and then we'll close up. Yes, sir.
Director Thompson, thank you so much. Tobias Peter with the AI Housing Center. So at the outset, you mentioned sustainability in lending, and you also mentioned closing the homeownership gap. I remember a couple of months ago, we had a conversation about the wealth building home loan and the LIFT home, the low income first time or first generation credit for these home buyers. Have you given, and which would in effect cut the default rate for borrowers in half relative to a 30-year and provide also a faster equity buildup? Have you given this any more thought? Where do you think stand along these lines?
So have I given it some thought, and where do they stand are 2 different questions. Have I given it thought? Of course I have. So what thought have I given? So the notion of a 20-year mortgage with a 30-year payment, what are the ways that you can make up that difference? And so is it some sort of liquidity fund? So just trying to think that through, and how can you implement that in a programmatic way? Where's the difference going to come from? So yes, I've thought about it. Where is it at? I'm still thinking about it, but it's important because I do think you build equity, a lot faster with 20 years, and then with the payment is really what is driving the desire for the 30-year mortgage. Is that payment. And so just trying to figure out how to close that gap is going to be really important. But it is something I think about a lot because it does achieve the objectives that we have in the equity space.
I think we have time for one more question from the audience. David?
Thank you, Director Thompson. David Dworkin, National Housing Conference. And I wanted to ask you about cash-out refinancing. This was a big issue, particularly in the Black community in the run-up to the crisis. Serial refinancing and equity stripping of people who were not getting bad loans to become first-time home buyers, were actually being refinanced out of good loans into bad loans. And now we are in a rising interest rate environment. Can you talk a little bit about what are the appropriate guardrails around cash-out refinancing when we know people are going to be refinancing from lower rates into higher ones? And what are they sufficient, and should we be thinking about more?
Well, you raise a really good point, and I would say this. First, we should be thinking about that, but I would say that looking at the books on Fannie and Freddie, we introduced a low AMI refi program for so that people who needed to reduce their payments could reduce their payments, and people just were not taking advantage of those low interest rates. When I was at another event in October, at the time, I think there were about 4 million loans on the books of the enterprises, and these were loans that were in minority neighborhoods that had interest rates over the 3. And at the time, we were looking at interest rates with a 1 and 2 handle. And so you're talking 3, 4, and these were loans that had been on the books since the early 2000s. I mean, we even saw a bunch of them that had 5 and 6% interest rates. So refinancing is really important, and doing it right is really important, and certainly doing it now where we don't strip the equity out of homes that really need a reduction of payment first, but they might be using equity to do, pay for college or something else. I just think it's really important. What I've seen and what I've heard is that closing costs are really an impediment to people refinancing, period. And so I do think that, we've been working with a number of sellers through the enterprises to talk about this very issue and making sure that, we understand. Certainly we can't make judgments for people, but understanding some of the lessons learned from the last crisis and just making sure that the programs and policies that are in place are reflective of those lessons. And equity stripping certainly is really important in that particular venue. But I mean, we're looking at it, but you can't stop people from making decisions, but you can provide information so that they can make informed decisions. And I think that is our role.
Well, I'm going to use my prerogative as the moderator to ask you the final question. We're a little bit over time, but you have enjoyed a distinguished 40-year career in public service, first at the FDIC and then for 10 years at FHFA. Any lessons learned over this period that you would like to share with others seeking a career in public service?
Sure. So lessons learned that I would like to share. Okay. There have been lots of lessons learned.
Maybe we could talk privately about some of
No, honestly, I think the biggest lesson that I've learned, and this comes after, at FDIC, I work for 7 different chairmen and women, some Republican, some Democrat, it doesn't matter. We are public servants, and our job is to make good policy decisions that have a broad impact that will reflect a better America. And for FHFA, we want to make sure that people have safe, decent, and affordable housing. And every decision I make, somebody's not going to like it, but when we make decisions, they're for the good of the country and not for one party or another. And I just think that making informed decisions based on our experiences, based on data, and based on understanding what the issues are, but also what the impact of those issues are, I think is really important. I did work in the private sector.
Okay.
And I think that helps me better understand the application of these decisions, because when you make a decision, sometimes you forget that people have to operationalize, like the credit score decision I was talking about. I mean, I understand that because I had to do it, but there's no better job than to work for the federal government. Someone asked, they said, well, we didn't know you were interested in the directorship. I never thought I had an opportunity to serve in this role. And it's a great honor, it's a great privilege, and it's one that I take very seriously because we're working on behalf of the American people. And I just think that we're going to probably increase our staffing, by a little bit, but the purpose would be to introduce more people to public service. And I really want to start bringing people into our agency that have a desire and interest in housing finance, but more importantly, housing policy, so that they can serve, and really impact the American people.
Well, thank you for that. And again, thank you for your very distinguished career in public service. And thank you for honoring us by taking a little bit of time out of your day to be with us here at the
Thank you for having
BPC.
me.
So thank you. And let me also thank our viewing audience, both in person and virtually, for watching today and for their very insightful questions. And let me close by putting in a plug for the next webinar in our Getting Serious About Housing Supply series. It will take place on April 21 from 1 to 2 p.m. Eastern Standard Time, where we will examine corporate initiatives to respond to the housing supply crisis. And you can find more information online at bpcdc.org/housing. So don't miss that one. So thanks again, everyone, and wishing you all a pleasant day.